So, Emily, you have some questions on the
I
covered call here
do.
today.
So yesterday we kind of switched things up on my lab. We actually had a lab last night, not today because I have some scheduling things going on, but we had a lab last night and we're talking all covered call stuff. So I came
Yeah.
up with three potential stocks. Actually, there were five, but we'll look at three today. And I may throw the fourth one in just to kind of get your advice because the markets are kind of picking it up today on how to pick up something as it's on its way down and waiting for that support. Waiting. But anyway, we looked at three potential stocks that we were looking to get in right away.
Okay, so you're not in these. These are things you're looking at as a potential covered call.
Yes, this
Okay.
is we're thinking long-term IRA account.
So can I ask a question very quickly?
Yeah.
Okay. So you're looking to get in not to a covered call, but you're looking to get into an investment of which you're going to write covered calls.
Correct.
Gotcha. Okay, I'm clear now.
All right. And there were three of them. And we looked at the three of them and we had three different approaches on all three of them. So here's the first one. So I want you to tell me whether this is the approach I should be taking because we were looking at this last night. Markets were closed. Markets are open today. So this is my first potential entry into all of these. First one is AMAT. This is Tackle 25. Darling that we love so much. So looking at yesterday's candle, we're looking at the overall trend, looking at the pattern where it was sitting at yesterday, nice little pullback to those moving averages. So for AMAT, the approach that I was looking to get into was just buy the shares now.
Okay.
And not cover them. Wait until it gets to about that 159, 160 zone and then cover it. So I want to be able to ride a little bit of that appreciation just because of where it was sitting yesterday.
Yeah, you like the retracement, you like the support level, you like the bounce from a couple days ago. You're treating this as a little bit of a bullish retracement. You get in, you ride as it starts to appreciate. Okay.
So that was scenario number one.
Okay. So do you want me to analyze each scenario or have you lay out all scenarios and then break it down as macro?
Let me lay all three of them out.
Awesome. Okay. Right. So Applied Materials number one.
Applied Materials, buy the shares now. We're not covering it until we get to resistance, then we cover. Yep. That's scenario number one. Apple, next one. So Apple did what AMAT should have done today. So that's the reverse. So Apple, I was looking at just getting in and covering it right away. And I was looking at the 165, 167 and a half strikes to cover it. So with Apple, I like the pattern. I like the trend overall. The resistance where Apple was, from where support was sitting at with Apple yesterday to where the resistance level is today, it wasn't that far of a move. So we were just going to cover that right away. We were looking at 165 and again, or 167 and a half to cover.
Yeah.
So Apple, 100 shares and we cover right away. That's scenario number two. Number three. Kroger, KR.
Okay.
This one was interesting because, and the reason I picked this is because we have earnings coming up here this week. And based on our asset allocation, kind of like how we were going to, approach this, we could buy up to 238 shares of Kroger, kind of based on the price.
Yeah.
So with Kroger having earnings, and again, this is, long-term portfolio. We like everything about Kroger. We like the P, we like the PE ratio. We don't care about earnings.
But we're not in Kroger.
But we're not in Kroger yet.
Okay.
So the question is, do I buy now or do I wait for earnings and buy after earnings? Or can I split it in half and maybe buy half now before earnings and then wait till earnings comes out and then get into the other after earnings?
Earnings is something we all have to learn how to navigate on different systems, right? With Delta systems, it's just to stay away. You treat it like you just stay away from it. It's hot stove, do not touch, right? You do not carry, especially in the options market, you just get slaughtered. And so you want to stay away from a directional system around earnings. Earnings carrying volatility systems through earnings are really, really powerful. Theta systems. So if you talk about Delta, Theta, and Vega systems, Delta is directional systems, Theta is cash flow systems, and Vega is volatility systems. So Delta systems are a no-go, no-fly zone, right? Delta Systems, they're all about technical edges and probability analysis, and earnings is a 50-50 crapshoot. So no fly zone for Delta Systems. Vega Systems, absolutely. They live off volatility, and earnings provides volatility. And so earnings is a lifeblood it's the blood of volatility system. So absolutely, yes. Straddles, strangles, short strangles, inverted flies, things like that. Creative volatility option strategies designed specifically for earnings. Yes, absolutely. Theta systems can be complicated around earnings because you certainly do hold long-term investments through earnings all the time, right? You don't get out of long-term investments because they report earnings. You carry them through. But if the primary purpose is covered calls, you never carry a covered call through earnings, ever. Like never, ever, ever. Have you ever played that game? Never, ever, would I? Never, ever, ever would I carry a covered call through earnings, ever. Now, it doesn't mean you can't cover something through earnings. It just means you have to collar it, right? You have to play the opposite side. You can't lock down your top side and then keep your bottom side uncovered, right? And that's what a covered call does. And so you got to be more into the collaring of that equation, which means you add in out of the money put option to protect against the downside. When you're this tight against earnings, I would say let's just see the numbers. I think we're this tight against earnings. I think we can just see the numbers because, especially right now, if you go look at the reports today that reported today, this is a difficult moment to report earnings in when you're dealing with as much uncertainty as the market is having right now, and you couple on that EPS numbers, revenue numbers, and guidance numbers, and it's a very difficult time. Most market participants that reported earnings today got beat up a little bit, even in when what you would consider a positive earnings for that company, they still got beat up because of the market volatility. I think we're too tight against earnings here to basically go into a delta neutral cash flow system where you basically write the covered call, add a put option, create a net neutral environment simply to overcome the earnings volatility. I think that's very complicated to do when all we have to do is wait a few days to see the actual results and then make a decision based on the information that the market is giving us. And so I would say on Kroger, and again, Kroger is in that zone for covered calls. There's no doubt about that. It's really, really good covered call stock. And it's something, if you're looking for a little bit of cash flow to the portfolio in a more conservative type company, Kroger really does stand out for that. It really does stand out for that. And if you're talking about an inflationary environment, if you're talking about a negative economic environment, Kroger really stands out there. Cheap food, right? Okay. We might not be buying expensive food a year from now, but I promise you we're buying cheap food a year from now. And so Kroger kind of stands out there. And so I like it for that. I just think we're really tight against earnings, and we probably should wait to see how the market responds, especially in the face of the market volatility here. And that's not too long. We're just talking about a few days. They report on the 2nd. And on a breakout there, and post earnings, you can certainly look at it. But even if a gap down and you start talking about a little bit of the 200-day, I could see both a negative response to earnings, a positive response to earnings. Both can provide a buying opportunity on this. That's why I say, let's see the numbers first. Let's see the market response first. Then we can start talking about how that fits within that portfolio. When it comes to Apple here, and again, you know, I've done enough live market analysis in my life to where you're looking at one data point, you're like, yeah, it's slowing down, market volatility. Let's write those covered calls. Let's go. Right. And then all of a sudden the market's getting spanked. You're like, yeah, I did. I made such a good decision writing that covered call. Why is Apple the only stock up today? You know, I get it. I totally get it, Em. But I'm going to have to disagree a little bit with the Queen on this one. And the reason being is Apple's in that catch-up mode a little bit to Microsoft. And this happens with those two juggernauts a lot. Microsoft's a little bit more consistent than Apple is. Apple will have these robust moments of catch up to Microsoft where all of a sudden Microsoft becomes that big blue chip, the number one company in the world. And Apple's like, wait a second, we got some iPhones to sell. They play catch up really, really quick. And so they're in that a little bit of that catch up with Microsoft, and you're talking a little bit about increasing momentum from a trend perspective. And outside the 1 day price cycle that really was just a snapback flag, got gobbled up pretty aggressively. You're looking at this as a little bit of a high base scenario, in my opinion. And in a high base scenario, I really like opening up that risk graph a little bit on the breakout here. Tightening it down, I get during the high base, but high bases can only last 3, 4, 5, 6, 7 days, right? They're not exactly that prolonged neutrality that you want to see that is really good for covered calls. And so I think on Apple here, and I talked about this in the Step System Mastermind group yesterday, it was the first stock we actually looked at when we were talking about entries versus stops, and we actually liked it from a directional perspective. I certainly see a cash flow expert like yourself coming in and be like, I can wrap a covered call here, but I did like it from a directional perspective. And so Apple's a good covered call stock in general, but it's a good stock for a lot of different systems in general. I like the directional edge here, opening up the little bit of the risk graph. We'll see who's right on that, because again, you sold the 165. We'll see if that plays out. But I actually like opening it up a little bit, even in a generalized market mentality where it's like, let's lock down those risk graphs as much as we can. Apple's kind of bucking that trend, but it's kind of bucked that trend over the course of the last month, over the course of the last couple weeks. Applied Materials here, man, it's in one of those zones where technically you love it. I mean, technically you love it. You love the retest of 145 here. You could really see a trader coming in and saying, "I love the directional nature here." Right? I want to look at this 145 support level as a little bit of an opportunity to pick up the stock. And as the trend starts building, once it shows some weakness at resistance, write that covered call out of the money. We know the playbook of covered calls on Applied Materials very, very, very well. It's been one of the longest standing stocks on the Tackle 25. Only, in fact, I believe Applied Materials has been on there 5 or 6 consecutive years. Apple's up there as well for consecutives. I think Microsoft had to be kicked off one year because we just couldn't get enough premium. It was so good, right? But Applied Materials has just been a very long-standing stock on the Tackle 25, and it's a great covered call stock. This is a zone where Applied Materials is typically, you want to gobble it up, wait for it to get into resistance, and then at resistance levels, a lot of times Applied Materials, it won't V-shape. It will hover. Right? It will hover, give you the time you like to write the covered call. I actually really like your a little bit of a scaling in technique to a covered call here. You're looking equity first, saying, okay, if there's 2 steps in the covered call, and I talked about this in the podcast yesterday, if there's 2 steps in the covered call, step 1 is to acquire the shares, right? Mm-hmm. Well, technically, if you're using your technical skill set, this is the zone where you start acquiring shares, right? This is the zone. And so you're looking at step 1, acquiring the shares, and then step 2 would be to write the covered call. Well, you don't have to simultaneously do step 2 while you also do step 1. You can take your technical skill set, allow a price appreciation, and then when it starts to show a little bit of weakness, immediately start writing those covered calls. And so I like the general zone, and I also like Applied Materials bucking the volatility of the last few trading days as well. Outside of Friday's candle, which didn't even, in my opinion, violate the support level, you've really seen an area of the market in Applied Materials that's been doing really, really well, or especially against the volatility of the last few days. So I like this as a zone to start picking up Applied Materials. And the equation of writing that covered call is really simple to me. Number 1, let's let it work up into that 159, 160 level. Let's let it work up. Let's take $7-8 of direction here. That's number 1. Number 2, as it does that and shows a little weakness at 158, 159, 160, write that covered call at that point, right? I like that game plan. Absolutely. It's a little bit of a similar game plan to what we do with bull call spreads oftentimes, right? Whereas, like, let's say a directional trader here comes in looking at the same scenario and says, well, I like buying a 160 call option right now. And as the market works to 160, I therefore am going to write the 170 call. It's a little bit of an aggressive scaling into a bull call spread. This is a little bit of an aggressive way to scale into a long-term covered call as well. Picking up the shares at support, writing the covered call at resistance makes a lot of sense to me. The question is, and that's all neutral upside potential, right? The question is, so a stock can go one of three ways, and you should always have a game plan for each of three ways, right? So you're looking at, in terms of the support level, you're looking at picking up. If it goes up, you're looking at writing the covered call at 159, 160. That would be writing out the 165, 170 contract. We just don't know what that would be at this point. The question for me is, what do you do if applied breaks support? Because if applied breaks support here, at that point, this pivot has failed. And when you're looking at the Russell 2000, RTY here, when you're looking at the Russell 2000, you had a very similar pivot here at 2,300. It failed. You see what the market did after that pivot failed. And so I like the game plan of what you're doing in picking up. I like the game plan of what you're doing if it goes up. I got to know the game plan if that pivot fails, because if that pivot fails, the game plan should be immediately write the covered call.
Yep.
Abandon the support plan. Support was violated, and you got to do something. You got to do something. And so I like also where I like a pre-planned, determined area where you also write that cover call to protect against downside risk here. And I like that if that pivot fails right here at about 142, you got some pretty significant 140 zone. But once again, if you're talking about accumulating the stock at 150, you're taking about 10 points of risk to the downside, the same way you're taking 10 points of return to the upside from a directional perspective. You accept that. You know you're writing a covered call at 159 to 160, and you know you're writing a covered call if it violates support at 142 by 140. That's the game plan. I like it. If I had to pick one of those three, it's Applied Materials. Applied Materials, I think, is in the zone. It's a fundamentally good company. You know the game plan about covered call. We got the upside to the downside. We know the strategy there and the plan there. I like Applied Materials. Kroger, I just think we got to wait for earnings. That's it. I love Kroger from a covered call scenario. And once again, if inflation is going to persist, I think you like food companies. I think you love food companies. And I think you really, really, really love cheap food companies. And so I do like Kroger here, and I like Kroger fundamentally. I like it from a covered call. This is just a really difficult time to report earnings when you have so much news coming into the market on a daily basis. And we're all hot take Monday, Tuesday, Wednesday, Thursday, and Friday in the market right now. And so I just kind of feel we should wait for earnings on Kroger. On Apple, man, I think it's time to open up that puppy and let it run a little bit.